Sometimes in a company's financial report, there's a single number that hides an entire strategic battle. Today, we're going to deconstruct one of those numbers, and trust me, it uncovers a fascinating story about sacrificing profit today to totally win the market tomorrow. Let's get right into it. Okay, so it all starts right here with this number. The company is reporting an 80 basis point improvement in a key cost ratio. Now, at first glance, you'd think, hey, that's awesome. It looks like they're getting more efficient, more profitable. But believe me, behind this simple little improvement, there is a much, much more complex story going on. So what is this ratio anyway? Well, it's all about efficiency. Think of it this way. For every single dollar the company makes, this percentage is what it has to pay out to its agents and for other related costs. So yeah, a lower number is exactly what you want to see. It means the company gets to keep more of the money it brings in. Simple enough, right? So the big question is, how did they pull this off? What's the real story behind this number that, on the surface, looks so good? As we're about to see, the answer reveals a really fascinating strategic choice they had to make. All right, so the report offers up a pretty simple, straightforward explanation at first. It's the clean, expected answer. And it all has to do with a major business move they made. And there it is. The company went out and made a huge acquisition. They bought Christie's International Real Estate. And just like they predicted, bringing this new business into the fold made their overall cost structure look a whole lot better. So, case closed, right? Well, not quite. See, that's just the surface level. The report itself kind of invites us to dig a little deeper. If we peel back that big acquisition, what is really going on inside the company's main, core business? And here's the twist. If you take that massive acquisition out of the picture, the company's core profitability, well, it didn't improve at all. It was basically flat. So, hold on. If the acquisition was a positive, something else must have been a negative, basically canceling out any of the gains. So what was it? It all comes down to this, a financial tug-of-war. On one side of the rope, pulling costs down, they had a little bit of a revenue boost from some additional services. But pulling hard in the other direction were higher commission payouts to their absolute best top-performing agents. These two forces were so perfectly balanced that they just canceled each other out. So you have to ask, why would a company do this? Why pay your top people more if it just means your core business doesn't actually get any more profitable? Well, here's the thing. This wasn't an accident. It was a very deliberate strategic trade-off. And here it is, the company's own justification, pulled straight from the report. They flat out say they are okay with this trade-off. And why? Because those very same expensive agents, they're winning. They are absolutely crushing it and capturing more of the market. So let's just break that down, because this is the crucial point. That higher commission, it's not just an expense, it's an investment. The company is actively choosing to give up some short-term profit in its core business to fuel growth and grab a bigger piece of the pie, all powered by its star players. Now, winning market share today is great, but it brings up a huge question about tomorrow. I mean, you can't just keep paying top dollar for star agents forever without it eventually hurting your bottom line, right? So what's the long-term play here? How do they fix this expensive balancing act? Well, the company lays out a really clear two-part strategy. First, they're going all in on recruiting promising up-and-coming agents. And second, and this is the key part, they plan to sign them with commission splits that are way more favorable to the company. And this, right here, this reveals their endgame. By building this whole pipeline of new talent that costs them less, they plan to rebalance their entire commission structure over time. It's the strategy designed to finally win that internal tug-of-war we saw earlier and set them up for long-term, sustainable profit. So that one simple number, that 80 basis point improvement, it wasn't simple at all, was it? It contained a whole story of acquisitions, strategic trade-offs, and a really bold long-term plan. And at the end of the day, it all comes down to this one critical question. Can this company actually pull it off? Can they win the market today with their expensive stars, while at the very same time building a more profitable team for tomorrow? Now that is the strategic tightrope they have to walk.